Our next guest is Head of Commodities Research at Standard Bank. Walter de Vet joins me now. Walter, thank you so much for coming in. Now, there seems to be, of course, a little bit of a debate. Now, there's always, of course, a debate on whether, the commodity prices can go even higher. We've reached record on record, or if we risk a collapse. Now, this, I imagine, has everything to do with China. Where do you stand on this?
Yeah, certainly it's got a lot to do with China, and especially if you go to the base metal, industrial metal side of things. And as far as China is concerned right now, we believe that we're at the peak of the cycle and probably going down in terms of the business cycle. Certainly from an industrial demand perspective, we are foreseeing a fairly weak next 2 quarters, possibly slightly longer.
So do you have any forecast on how much the price of certain commodities can go down by?
Yeah, I mean, it really depends on specific commodities. Take something like copper, of course, which has reached all-time highs in the past 2-3 months. We certainly think that it could go down another $600-700 a ton. But even then, if copper trades at $8,500 a ton, it's still very, very high levels, especially when you look at a cost of production perspective.
What about some of the other commodities? Because I was going through your note, and actually you still have a buy recommendation on a lot of the platinum, gold, but also nickel and palladium.
Yeah, certainly, from the buy recommendations, we also, of course, look at the supply side of things. Metals like platinum, palladium is really constrained in terms of supply, and completely different from, for example, a copper. And then, of course, also if you look at the precious metals perspective of things, monetary policy in general still remains very, very accommodative, and real interest rates very low, even in countries like China, where inflation is much higher than the deposit rate. So that really favors precious metals.
But Walter, I know it's quite difficult, but overall, are you not actually ruling out the perspective of a very big correction? Are we going to see these prices, go down by 20%?
Yeah, it is possible, and we're not ruling it out. But if it goes down by 20%, we do believe it's going to be short-lived, because we see, especially from the demand side, we're not at the end of the commodity boom, and it all depends on the business cycle of different economies, especially China, but also the US. So long-term, we still see good, robust demand for most of these commodities, and it's just what the supply side is going to do.
But so if we see a correction, it would be more to do with investment sentiment or risk aversion? Absolutely.
Investor sentiment, risk aversion. Of course, these days there are a lot of money as commodities as an asset class, and it can move in and out of commodities. But the underlying real demand is still there. You just need to find the right price levels.
Is there something that will make you trigger that sell-off, or that will trigger that sell-off that gets you scared, or that you're especially watching out for? I know we've talked about indications in the Chinese economy, but is there one figure that's coming out that you say, well, this is going to give us the impetus for either a correction or another rally?
Well, there's obviously always many indicators, but certainly for the next couple of weeks, we are looking closely at what's happening in China and what the People's Bank of China is going to do in terms of monetary policy, because really that is what's going to affect real demand on the ground.
What about gold? It's an asset class in itself, of course. It's the hedge against inflation. Is this going to withhold no matter what happens?
No, it's also obviously subject to what especially monetary policy is doing. In that regard, we are looking closely at what the Fed is doing, and of course also what government borrowing in general across the world is doing. Those 2 factors are key to gold for us, and we think it's going to remain supportive for gold. And then of course also what policy rates are doing in the US, especially if they start raising rates, it could affect gold negatively.
So what's your top tip to investors? Is there anything that you think looks safer right now?
Well, we still like gold. We still think it could go higher on a 6 to 12 month basis. That's our safest bet, not necessarily the best bet. And then we also like, as you've mentioned, we still like platinum, palladium on a 12 to 18 month horizon. And then also even metals like copper, although we are short-term bearish in the next 6 to 8 months, we still think going into 2012, 2013, the market is in deficit, and there should be higher prices.
All right, is there something that actually investors should absolutely stay away from?
There's definitely some risky commodities out there right now. With silver, although it could probably trade higher, it is very, very high at these levels from a cost of production perspective, and also from a demand perspective. It has rallied a lot, and you should be careful.
All right, Walter, thank you so much. Walter the Vet there.